Good morning and welcome to our second episode in our four-part series on value creation for private equity. In our previous episode, we spoke about the economic outlook in South Africa and globally for investment strategy. And today we'll specifically be looking at what private equity firms are looking for in their portfolio companies as it relates to value creation and different sources for performance uplift. Now, I'm really excited to be joined in studio by my fellow colleagues, and I'll introduce them. So we've got Suleman Jhavary, who is a partner at PwC's Strategy and Transformation business. And we've got Jaco Prinsloo, who is a partner in our deals business, specifically looking at value creation. Thank you very much for joining us.
Thank you. Good morning.
Sure.
So, with a more supportive macroeconomic backdrop forecast for South Africa for 2025 and 2026, primarily driven by lower interest rates, and we are seeing a slight uptick in deal activity, the topic of value creation throughout the investment lifecycle becomes extremely important. I think we can dive into the questions. So, Suleman, this one's to you.
Sure.
PE firms ultimately expect their portfolio companies to deliver strong returns, both through performance during the holding period and through a credible growth story at exit. So against this backdrop, what are areas that PE firms are specifically focusing on today to drive this value?
Look, it's quite interesting. And what we're seeing is a very balanced forecast in terms of what they focus on. So the fundamentals are quite important. Let me share those with you. The one is price. In other words, are they selling at the right price? The second is cost and cost optimization. And that's underpinned by efficient working capital optimization. We are also seeing an element of commercial excellence. And the commercial excellence focuses on what we refer to as mix and margin. Are we selling the right products at the right price with the right portfolio of products? It's about sales force efficiency and, more importantly, customer experience. Those form the backdrop of how value is actually delivered. Now, we are seeing some companies that are focusing on scaling some of this through acquisitions and disposals. But in the mid-market space, the three fundamentals remain. It's around price, it's around cost, and working capital optimization. There is an element around the operating model, but I think that's an area that follows if we get the fundamentals right.
Okay, thank you. Price, cost, and working capital optimization. So, Jaco, given that context, are you actually seeing a shift in how value creation is being approached, especially in those kinds of investments?
Yeah, sure. Absolutely. As Suleman said, it's making sure you get the basics right, but then absolutely accelerating from that point forwards. Businesses realize that they need to create value, even more so when they've just gone through a particular transaction, and even more so when private equity gets involved with that fresh capital and now expecting an appropriate return. So we are seeing a much faster drive towards value creation, starting that from day one and making sure that that value gets bolted into the organization. They're expecting more from management, but it's also allowing management to take ownership of these initiatives. And that is through the release of better data, so better quality, more informed decision-making, and where appropriate, the deployment of technology. But as Suleman also sees in the market, technology is not that silver bullet. So technology on its own is not going to bring the change. It is still being done by people and for their customers and their clients. But it's that combination of a credible plan, a drive for action, appropriate capital, and then technology where needed. And if you get those, again, getting the fundamentals right allows you to create that value in a sustainable way for your organization.
And I think the fundamental of what you mentioned is the quality of the data. That is extremely important. Thank you for that. So Jaco, again to you. Deals are often described as a catalyst for change. In practical terms, how do you use the moment of the transaction to actually kickstart the transformation?
Yes, it's a great question. Deals give you this wonderful opportunity, which is you have the combination of a deal thesis, so knowing why we acquired the company and what we want to do with the company. You have clarity on that. That's a great starting point. Secondly, you have the alignment of all the stakeholders. So both the funders, quite often private equity, as well as management, are therefore aligned from a stakeholder perspective. So now we know what we want to do and we are aligned as a leadership team. And then thirdly, you're getting fresh capital. So there's new capital, there's new ability from which to grow, with new capital. And again, that capital could be used for driving greater sales force effectiveness and greater margin expansion. It could be used to take out the unnecessary cost, or it could even be used to fuel some of that working capital release that you need. So the fresh capital, the alignment of stakeholders, and ultimately the deal thesis allows you to do that. And we therefore see that these deals often go through a transact to transform process. So there's a transaction that took place. Now we can start focusing on the appropriate transformation. And as I said earlier, starting that earlier and with far greater impetus.
Okay, thank you. Very interesting. Transact to transform.
Mm-hmm.
Okay. Suleman, so we've talked about using the deal as a catalyst for change. And I really like that. Because it's value creation from day one, and that's powerful. But how does the transform side of transact to transform actually set you up for a better transaction?
So fundamentally, it's about value. How quickly can you deliver it and how sustainable is it? Let me make it a little bit practical for you. It focuses on a couple of areas. First of all, we talk about revenue, but it's more about quality revenue, which is backed through sustainability and predictability. So that becomes very important. Then it's about your cost. And I guess everybody goes down to how do we get rid of costs? That's not always the answer. It's about making sure that you focus on driving non-value added costs out of your business, actually spending on those costs that differentiate you and create your brand. It's about spending on customer experience. That's ultimately important. And then understanding where there are inefficiencies in your business. And where we find these inefficiencies, that's where you probably focus on getting rid of costs. Those become the fundamental pillars to drive value. Coupled with that, we talk about working capital optimization and then operating model, which is aligned to your long-term strategy. We spoke about, digital enablement. It's extremely important. But I think we just mentioned that fundamentally it's about data and data quality. If those fundamentals are in place and we deliver, you'll deliver long-term sustainable value.
Okay, thank you for that. I think we've covered the principles, but what I'm really interested in is bringing this to life now. So let's bring it to life. Is there a moment from the last year that you can think of that you can share with us?
Yeah, sure.
Yeah. You want me to go? Because
maybe go for it and I'll share one of the examples we worked on as well.
Yeah, because we're helping a client at the moment. And I really like, Suleman, what you said about the sustainability of the savings. This is not just a short-term gain. It has to be sustainable because, again, that value has to be sustainable throughout the process. And if it's not, you're never going to get the return at the end when you potentially think of selling this business.
That's it.
So one of the clients we're helping at the moment, quite interestingly, we're actually starting on the working capital side. So yes, we can see there are opportunities of enhancing the sales team, opportunities on the cost side, but starting on working capital actually brings about that fuel for growth internally. So there's excess inventory, payables is not optimally managed. And so by releasing excess cash in this business, you can ring fence that value that you've created. And now you start deploying that into different parts of your business. And in that instance, you don't even need to go to your private equity shareholders and ask for additional capital. You're generating that internally with the right focus, with the right impetus, and then that launches you on this growth trajectory. And throughout the process, you're creating value because you're more efficient on your cash conversion. You are taking out, exactly to your point, unnecessary costs. So not cutting to the bone, but it's taking out what is not value adding. And then ultimately, you have to drive the top line performance. And we're seeing that happening at this moment.
Brilliant. I'll share one with you. We're working with a company, extremely successful. They're delivering, but they felt they reached the value ceiling. So we looked at the organization in terms of those three fundamental principles. We started with price and product mix. We found that they were selling 600 products. Of the 600, they were only 20% contributing to 80% of the revenue. There were some in there that were purely, if we stopped them, we would have just dropped to the bottom line. So we helped them restructure their SKUs, understand the cost to deliver, and we actually optimized their production process through that. It became self-funding. Once we developed the case for change and we started delivering value, they actually reinvested in their operating model. So very similar. It's about how you self-fund these projects. And over the long term, it actually delivers sustainable value.
Yeah, and I like what you say. I think that it's sometimes a focus on simplicity. There's another client we're helping at the moment. Your example of 600 SKUs. This client has 13,000 SKUs. and only about 20 of them really drive significant value in this business. So why have 13,000? And it doesn't mean don't have any of those.
Yeah.
It just means be smart about what is, again, adding value to your business and focus on enhancing that as opposed to trying to keep everyone happy.
Absolutely. And successful companies go through a process of adding to their product portfolio, but do they actually go back and look at what's delivering value? So it's about fundamentally focusing on that. It's the simplicity that drives value and the independence that you bring in that allows them to see, where they actually can deliver a lot more value.
And I think to our earlier discussion, what really underpins that is actually the ability from the data and the insight you get from that then now makes a really targeted discussion as opposed to a broad brush approach. And so you can be really practical in terms of what needs to happen and measure that impact.
Absolutely.
Okay, thank you very much. That was really insightful. And I think, it's a longer term journey, but there are some of the quick wins, like you mentioned, and there are some of the low hanging fruit that companies can already start looking at. Well, thank you very much. Unfortunately, we are out of time, but I really, really enjoyed the discussion. Thank you for joining me in studio today.
Thank you.
Pleasure.
So what we're seeing in the work that we're doing with our private equity clients is that value creation isn't necessarily reactive to underperformance, but it's something that is proactive. It is something that is structured. And very importantly, it's something that is data-driven. Now, whether that is going to come in the form of improving the quality of revenue, working capital optimization, business model reinvention, the key is to understand where the focus areas are and then to be extremely driven in those focus areas and take management along on the journey as well. Thank you very much for joining us. I do really hope you enjoyed the episode. Please join us for the next episode in this 4-part series, which covers value preservation. Have a good day. Bye-bye.